how to not lose money. It's simple. Don't be ignorant or greedy, and don't invest in products you don't understand or those that may not be suitable for your investment needs and timelines. Meet 35-year-old software engineer who heard from colleagues about a cryptocurrency that had risen 300% in 3 months. Without researching or understanding how cryptocurrencies work, he invested 5 lakh rupees in 2021. Within 2 months, the value crashed by 80% and he lost 4 lakh rupees of his hard earned money. Compare this with his colleague Meena, who invested the same 5 lakh rupees in a diversified portfolio of equity mutual funds, government bonds, and a small amount of gold after researching each option. When the market experienced turbulence, her portfolio dipped by only 12% temporarily before recovering. It is human nature to want the highest return possible, and most people think they can beat the stock market in the short term. However, return is just one of the factors you need to consider while selecting an investment portfolio. Equally important is how comfortable you are with the fluctuations in the market values, your requirements for regular income versus capital growth, and your investment time frame. Before investing, first determine your objectives for investing money. Here are some of them. Regular income. If you want to get income on a regular basis from your investments, you should consider investing more in assets that have low volatility. The returns may be lower, but your capital will be safe and you will get an assured regular income, and thus it will meet your objective. Capital growth. Capital can grow significantly if you invest for a long term duration. Therefore, investing in growth assets like equity or real estate is recommended. These assets can deliver high returns if you hold them for long term. Income and growth. In case you require income but want to grow your wealth as well, usually a requirement of retired people, then a combination of income and growth assets is recommended. You should decide the asset category only when you know your financial objectives. Here are some additional ways to not lose money. Don't buy any products you don't understand. The Joshi family was persuaded by a smooth talking agent to invest 10 lakh rupees in a structured product that promised guaranteed returns with market linked growth. They didn't understand the complex fee structure and exit penalties. When they needed money after 3 years, they discovered their investment was worth only 8.5 lakhs rupees after all the hidden charges. Don't buy something just because your friend bought it. Rajiv's friend Prakash made good money investing in shares of a pharmaceutical company and encouraged Rajiv to do the same. Without doing his own research, Rajiv invested 3 lakh rupees in the same company. Unlike Prakash, who bought at a low price, Rajiv bought when the stock was already overvalued. The stock price fell 25% in the following months, teaching Rajiv an expensive lesson about following others blindly. Don't invest based on tips from TV anchors blindly. Meera watched a financial news channel where an analyst enthusiastically recommended a small cap stock, calling it a once in a lifetime opportunity. She immediately invested 2 lakh rupees. 6 months later, the stock had fallen 40% amid revelations of accounting irregularities. The TV analyst had moved on to recommending other stocks, taking no responsibility for his previous recommendations. Never buy insurance as a form of investment. Ajay, a 28-year-old professional, bought a unit linked insurance plan that required him to pay 1 lakh rupees annually for 15 years. The agent promised high returns plus life insurance cover. After 5 years, when AJ checked his policy value, he was shocked to discover it was worth only 3.8 lakhs despite having paid 5 lakhs in premiums. High administrative charges, fund management fees, and premium allocation charges had eaten into his returns. Have a diversified portfolio. Meera family invested their entire savings of 30 lakhs rupees in real estate, buying a second property for investment. When property prices in their area stagnated for 8 years and they needed money for their daughter's education, they couldn't sell quickly and had to take an expensive education loan. Had they diversified across asset classes, They could have easily liquidated some investments without stress. Most importantly, don't buy something without understanding it completely and doing your research. Get a second opinion.